Okay, so I did the multiple choice first in this. Okay, so the first one, I've got option 3.
Option 3, looking at carrying value, book value, yes. Okay, so yeah, in this paper as well, in terms of the 70 marks, there was only a few marks given for section A, 20 again. So that's kind of the trend. You're right here, 3 was correct, the original purchase price minus the accumulated depreciation. It's more of an accounting question than a finance one, but anyway, it's correct.
Okay, in comparing internal rate of return and net present values, this one is option 2. NPV is theoretically superior, but financial managers prefer IRR.
100%, because it's a percentage and they can compare it to cost of capital, yes.
Yeah. Okay, then 3, the cash flow, it's option 2, it's 1.8 years.
Yes, okay, because you had to look at this 40,000 and when do I get it back? So after 1 year I get 20, after 2 years I get 45.
Yeah.
So it's slightly less than 2 years.
Okay, mutually exclusive duration. I wasn't 100% sure about this one because all the other times we've looked at this, the methods of comparing mutually with different durations, we use the annualized NPV to basically look at it. But I went with option 3 here, equates over an equal number of years.
Yeah, that is annualized NPV, because evaluate over an equal number of years would be, if I've got a certain number of years, I'm going to evaluate them over the equal number of years. So, for example, let's say a project, so it's kind of like annualizing it, but looking at it in terms of time. So it's not the best answer in terms of annualizing the NPV, but it would be fine to evaluate them over the equal number of years, because then you're taking the time element out of it, basically.
Yeah, cool, 100%. Okay, then the next one, I got 4. None of the above is correct.
Okay, for this one, no, be careful. Your working, I think, wasn't correct. Just do the calculation again using your calculator. You're looking for, remember, they said annualized NPV.
Yeah.
Okay, so you need to use the NPVs as your PV, and then you're solving for the payments.
Okay.
Okay, I think you also got stuck with one of these yesterday.
Yeah.
So just try again. Just be careful with the working. Remember, your NPV becomes your PV.
I put it, and then you're calculating for FE.
No, PMT, because it's annualized NPV.
PMT.
Yeah,
okay, so then what is your? Okay, so then you wouldn't have a PV then. I was calculating for PV anyway. That's probably why. Okay.
Okay, I'll just try it again and see which option you would go with.
$1 million. So a project M is $1 million.
Yes.
So it's option 1.
Correct.
Okay, cool. I'm happy with that. I know what I did wrong there. Okay, the cost of capital. So you do the whole PV thing, and then you obviously minus the tax. It's option 1, 3.6. I think it is. Yeah.
Yes, looking at the bond calculation, good. So all you had to do there was take the time value of money into consideration. Yeah, you had to plug in the values into the calculator.
And then minus the tax off the 5.97.
Definitely, yes, because remember, debt has interest that's tax deductible, so you always take off the tax.
Yeah. Okay, then the number eight, I didn't really have an idea.
Okay, you got option 1 here for 6, eh?
Yeah.
Good. All right, so 7, you didn't have an idea. This one.
No. Yeah, I don't know if I was using the right formula for it.
Okay, what is a pref share?
Is it a pref? Oh, that's why I didn't. I was trying to use this for a normal share. That's why. So
you can't, because a preference share is paying out a dividend of 10%, basically forever.
Yeah, sorry, man.
So it's kind of like a perpetuity.
I didn't read
you've got PV, which is the dividend.
Yeah.
Over the rate. If you want the PV and there's flotation cost, what must you do? You need to use the net PV.
Yeah.
Okay, so it'll be N equals div 1 over R. And then you just solve for the R.
Yeah, okay. Perfect. So what is, okay, so can we just work through it quickly? So
yes, work it and see what you get.
So we've got shares issued 2 million at 10% preference shares. So you've got 200,000 preference shares.
No, not 200,000 pref shares. The 10% is the rate that you're paying in terms of the dividends.
Okay.
Okay, so the dividend is 10% of the par value of the R2.50.
Okay. And the flotation. Okay, so your PV
would be the net proceeds. R2.50 less 10%.
So it would be R2.
Less 50 cents. Sorry, less 50 cents.
So it would be R2 with your dividend being R2.25.
Yeah, the dividend is 10% of R2.50.
Okay. And then you would calculate the R. So your R equals you end up timesing the two together, don't you?
Well, you're moving the one to the left and the one to the right, so it's divide. So if you want to rearrange this, if R comes to the left, then you'll take the PV to the right. And
then you divide, okay. So it becomes, okay, so then So you basically end up with R is div over N, but there's no, so it's pretty much the same as the cost of a new issue of an ordinary share, except there's no growth.
Yeah, there's no growth because the preference shares is 10% forever.
Okay, cool, 100%. Okay, so then you'd have 0.25 divided by 2 equals. So you have times by 100 is 12.5%.
Yes.
So option 3.
Yes.
Okay, 100%. Okay, the next one, I got option 3.
For 8, option 3,
no. No, 8 was option 3. 7.
7 we just did.
Was that 7? Why have I got... Oh, no. I didn't even do 7.
7 was the one we just did, the Spectra Limited issuing pref shares.
Okay.
Yeah, that was the one we just discussed now, 12.5%.
Okay, then I've done something wrong here.
Maybe you're numbering.
Yeah, I don't know.
Yeah, 6 was the debenture one, 7 was the pref shares. 8 now is looking at an ordinary share calculation.
I missed 8 and 9 out completely.
Oh.
No, I didn't. I've got 9. I didn't do 8, I don't think.
Okay, so quickly do 8 then. 8 is talking about the EPS and calculating the cost of a new ordinary share issue.
Yeah, that was the one I actually got stuck with. I didn't do 7, actually. I skipped 7, actually. That's the one I skipped. I didn't do 8, and that's the one I was battling with.
Okay, so 7 you skipped, which we've already covered now, 12.5%. Yeah. That one's fine. 8 now, what would you do here?
Well, the formula is R equals D over N plus G, because that's the formula for the new share.
For the new share? Okay, good.
For the new share, yeah?
So?
Over N plus G. Okay, so the EPS is expected to increase to 4.8 per year. So that would give you your growth. Would it not? The expected increase of the EPS.
Okay, well, what are we trying to do? We're trying to get what? The new share issue. So let's write down the formula first. What would the formula be for an issue of new shares in terms of cost?
R equals D over N plus G.
Okay, so R equals div 1 over n plus g. Okay,
Yeah.
so now, what do they give us in the question? What can we substitute into the formula?
R. Because you've got what the ordinary share sells at 42 Rand. So you've got 42 Rand.
Okay, so 42 Rand would be what? The price.
The R, yeah. So that would be the R.
No, it wouldn't be the R. R is the rate. That's what you're solving for. That's the cost.
Okay.
Okay, that would be the 42 Rand. So that we could use here. Net proceeds.
Okay. 42 Rand, okay.
42 Rand less what? The flotation costs.
The flotation costs. Okay, minus 10%. So minus 4 Rand 20.
What else do you know from the question?
Pays 45% of its earnings as dividends.
Good. Okay, we're paying 45% of our earnings as a dividend. So can I work out div 1?
Yeah.
Yes. Okay, div 1 is going to be what?
I do know this. Well, that kills me all the time. Is dividends over share? Oh, no, that's DPS.
Well, what did the question say? 45% of the earnings is the dividend. So?
45%.
Of?
I don't know what the earnings are.
You've got it. EPS.
Okay. Oh, so 45% of EPS?
Yes, because EPS is the earnings per share.
Okay. So which one would you use? Would you use the 486 or the 440?
Well, what does the equation use?
Well,
div 1 or div 0?
Calculate both. You'd have to calculate one to get both, to get the growth, I mean.
Well, that's if you're looking at G, okay, but I'm looking at what here? Div 1.
We'd be looking at, but we'd be looking at, so it would be the 486.
This would have been times 0, this would have been time 1. So T1, 45% of this would have been D1.
Yeah. Okay.
Because current EPS is 4.40. Expected increase to 4.86 next year. Next year is T1.
Okay, so it's 1 Rand 98.
1 Rand 98. 1 Rand 98 is the current dividend. That's for T0.
Okay.
You don't want T0, you want D1, which is T1.
Okay. It's 2 Rand 19.
2 Rand 19, yeah, that's better. But I wouldn't use 2 Rand 19. I would use 2 Rand, 187, and then I'd round up the answer. But yes, okay, so you've got that.
Yeah.
There's the dividend at time 1. That's what you put into the formula.
Okay.
Okay, and if you put that into your equation, you get what? 5.7.
Okay, but now what about the growth?
Yes, the growth we can look at now.
Okay.
I'm just showing you the first part. Okay, so you write by saying look at the growth in terms of the two EPSs. Do you agree? Okay, so now I've done the working here. So obviously you said PV 4.40, FV 4.86, you can work out the growth. Okay, that's correct. If you work out the growth, you get 10.454545.
Okay, and then you add the two together.
Well, you can, but you only add the two together if the growth is assumed to continue after T1. Okay, because remember with Gordon growth, you're expecting the growth to be applicable in all years into the future. Does that make sense?
Yeah.
Okay, so now the question didn't say if the growth will continue from T2 onwards. Does that make sense?
Yeah.
The question only gave you information about T0
so
and T1.
So then option 1 would be the right answer.
Yes, okay, because yes, normally you would look at growth, but that's only if growth is assumed to be constant from that point onwards.
Okay.
Okay, so they don't mention that, and that's why you wouldn't include this. You can work it out, that's fine, but you wouldn't include it in the
give you the
calculation.
15.79 though, wouldn't it? No, it wouldn't.
Pardon?
Doesn't even, it doesn't give you anything close, because if you put the 10,
it won't,
that, it gives you 16 point something.
Yes.
Okay, cool, 100%.
Okay, option 1.
Okay, then question 9. I don't know how the hell I skipped number 7 to that. Okay, then question 9. We're looking at the optimal cash structure. It's the normal WACC. I got option 3.
Option 3, 9.25%. Good. Okay, so it's the weighting of debt and the weighting of equity. So if you take the two weights and you times it by the cost, just remember that you need after-tax cost for debt, and as long as you've got the correct values, you will get 3. Good.
Yeah, I'm quite happy with the WACC and all of that stuff. Okay, I've got option 2 for this, 2.82%.
For DOL, yes.
Yeah.
Okay, for
so
DOL, you needed the equation. Okay, so you asked me about which equation do I use. It doesn't matter which equation you use. You can use this one or you can use that one. You're still going to get the same answer.
Okay, cool.
Okay, 2.8 is correct, option 2.
Yeah, cool. Okay, then we did that one. Then for 11, I got option 2.
For question 11, option 2 is correct. Yes, DFL. All right, so same thing with DFL. Previously, you were asking me about equations, so just to show the working here.
This one, I've actually got this now, because if they give you the actual, so if they give you things like the interest and amount of interest and stuff, because the other one's a change in, it's the same as it's the same degree of operating leverage. It's a change in something and the change in. So if they give you the change in sales and the change in EBIT, then you can do the degree of operating leverage.
Yeah, but a change in would require you to have 2 separate years.
Yeah, 100%, yeah.
Yeah, so that's fine. And you plug it into the formula, and you do get option 2.
Yeah, option 2, that's it, yeah. Okay, then the next one, I'm not sure what, I did the value of the company thing for number 12. So it says company sales revenue, the variable. So I calculated the NPAT, okay, because that minus the variable costs, minus the fixed costs. Actually, why did I not write it down? Definitely did do it. Let me just do this again. 25 minus 90 minus 15 equals 10,000. Interest of 1,000. I don't know what the hell I did, yeah. That's probably why I got to the amount I did. Minus 5,000, so that's 5,000. Then the tax rate of 30%, so that's 150 Rand, so 4,500. 4,500 times by 17% divided by 17% equals. No, I don't know what.
Okay, what are they asking you about here? Value of the company, right?
Yeah.
Okay, when you see WACC and they're asking you about value of the company, you should be thinking about firm value.
Yeah, okay. So isn't that NPAT over WACC?
Yes.
That's what I try to use.
Good. So you just need to work out each one separately. So what was your net profit after tax?
Well, the net profit after tax, 4,500.
4,500? No. 4,500 was the tax.
Okay, but if you take 125,000 Rand in sales, minus 90, okay, minus 15, that's already 100, that only leaves you with 10.
What about the interest?
Yeah, the interest, I'll take it minus the interest, leaves you with 5,000 Rand. So the tax on 5,000 Rand is only 150 Rand.
No, tax is 30%, so the tax would be that.
No. Yeah, but Anthony, if you add up 90 plus 15 is 105. Oh, that's where I've gone wrong. 90 plus 15 is 105, 110. So you've got 15,000. And then your tax is 30%. Yeah, okay. Sorry. Yeah. I just did a mental 10,500. So then 10,500 divided by 17% equals. I don't know what I did. I don't know what I was doing with this, because this is generally quite easy. So 61,765. So option 1.
Yes.
I actually know this. I've done this. I've done this in all the other exams, and I've had no problem with it. I don't know why I had such an issue with that one. Okay, number 13. I got to option 2.
Option 2 for the breakpoint, good.
Yeah. And then option 3 for the other breakpoint.
And option 3 for the other one, for 14, breakpoint of 600,000. Option 3, yes. Yeah, so those are pretty straightforward. You just have to take the actual amounts and divide it by the weightings, basically.
Yeah, I'm quite happy with the breakpoints. Okay, I got option for 17. No, sorry, where are we? We're at 15. I got option 2.
Yes, they test this clientele effect quite a bit.
Yeah. Then I got, for the next one, I got option 1.
Yes, for option 1, you've got the company's EPS.
Yeah, so you just had to do a calculation for the profit in order to do the EPS, which is profit over ordinary shares, basically, in this, because there's no preference shares.
Yes, yeah, so it's EPS profit over the number of shares, correct? As you said, you've got to first work out the EBT. Once you've got the EBT, you can then calculate the profit, and once you've got the profit, you can then work it out. Yeah.
So it was, that's I'm quite happy with those sort of ones. They're quite easy. For the next one, I got 4.
For 17, option 4, yes. Okay, Miller and Modigliani were looking at the value of a company, okay, being affected by certain factors in terms of debt and equity and dividend policy. Obviously, if you choose to raise more capital through debt or equity, it isn't going to basically affect your valuation in terms of a company, okay? Because companies can choose whatever they want to. They're saying that the company's capital structure wouldn't affect the value of the company, and it wouldn't affect the dividend policy, or the dividend policy wouldn't affect it either.
Yeah. Okay. Okay. For 18, I got 4.
The factors involved in setting a dividend policy. Okay, if I'm looking at dividend policy, capital impairment restrictions. Okay, capital impairment restrictions meaning you're not allowed to reduce the value of your capital in any way. Okay, so they're saying which factors will affect a dividend setting policy and which one doesn't.
Yeah.
Okay, so let me ask you about restrictive covenants in a bond indenture. Would bonds affect your dividends?
Yes.
No, it wouldn't. How would bonds affect dividends?
No, it wouldn't. Just sorry.
Bonds is looking at interest payments. Those are coupons.
Yeah. Okay.
Okay, the rest will. This is actually spoken about in quite some detail in the textbook, where they talk about how factors can affect your costs in terms of raising capital, and obviously this would be looking at the equity.
Yeah.
And this would be looking at the debt. So the one that's out is the debt, because you're not looking at it. You're looking at a dividend policy. Dividend policies belong to shares or equity.
Yeah. Okay, cool. Got that.
Okay, 1 is the correct answer.
Okay, so I said the overriding goal for merging is option 2.
Yes,
maximize wealth. Yeah.
Always.
Then the last one, merger is undertaken either strategic or financial reasons. The only strategic one I could see there is to achieve various economies of scale. So option 2.
Okay, economies of scale isn't a strategy in terms of undertaken for strategic or financial reasons. We're looking more at cost there. Okay, economies of scale would be the costing rather. So this is asking which of the following apply to a strategic merger.
A low-cost strategy is a strategy. But a low-cost strategy is a strategy.
Finance. That's
but
a
low-cost strategy. Yeah, but I mean, a low-cost strategy is a strategy, though.
Yeah, but it's a financial strategy, not a strategic strategy.
Okay.
Okay, strategic, if you look at the context in the textbook, they talk about strategic as giving you an advantage from a operational point of view, or maybe a product point of view or a value point of view, but not in terms of costs.
Well, but you see, then I disagree with the financial textbook, because all the other management textbooks talk about low cost is a competitive advantage strategy as per Porter.
Yeah, but it's a financial reason. So I agree, it is a strategy, but it's a financial strategy.
Yeah, but I mean, it's...
Okay, let me get the textbook quickly, and let me just read you the theory just for those two things.
Look, I'm actually not really worried, because it's only 1 mark. Really, if I don't... It's like 1 mark. It's not really going to make a difference to me.
But still, 1 mark is 1 mark, hey?
Yeah.
Alright, I mean, it's something as simple as theory. I mean, that would have taken like 30 seconds to do, and you're getting a mark.
Yeah.
I mean, some of these other multiple choice questions take like 5 minutes to calculate, and you only get 1 mark.
Yeah.
I just want to get the page reference for you. This is looking at the mergers and the financial versus strategic. Okay, so that's on page 600 and okay. Alright, let's just find the right reference for it. It's on page 697, there we go. Okay, the definition for a strategic merger, according to the finance textbook, says a merger transaction undertaken to achieve... Oh, okay.
Various economies of scale.
Yeah, economies of scale. And then financial merger, a merger transaction undertaken with the goal of restructuring the company to improve its cash flow and its hidden value.
I mean, I've learned every single
you're right. Sorry, that's my mistake.
Every single management subject I've done, it's Porter's 5-4, it's Porter's competitive advantage.
Okay, you're right.
Competitive advantage. The one of the generic strategies is a low cost strategy.
Yeah, no, I agree with you. Sorry, I made a mistake. You're correct.
No, cool.
Okay,
I've just done about
question 20's answer. A merger undertaken to achieve economies of scale. So yes, agreed. Okay, so let's correct that one. Let's make a reference here. This is option 2.
Yeah.
Option 2, and then the page reference, question 20. Okay, so it's a good thing to check these things. Page.
I've done about the things I've done this, like some strategy stuff in every single business, every single one of the business modules you do. It talks about generic strategies, and the low cost strategy is definitely one of them.
Okay, yeah, no, that's correct. I agree. I just didn't correctly identify the right reference.
100%. Okay, cool. So if we move on to the long questions. The first one's initial investment. So we've got installed cost of new asset, which is 450,000.
Okay, so yeah, let's look at these ones now. Let's see. Yeah, section B, long.
Yeah.
Okay, so you started with the first question, which was calculating INV.
Yeah. Okay, so the initial investment is 450,000 is the installed cost of the new asset.
Because it doesn't mention investment is 450,000. Agreed. No setup costs.
Yeah, the installed cost, because there's no other. It doesn't mention any other costs there.
That's right.
Your proceeds of the sale from the old assets is 294,500, which is made up of 280,000. Okay, and then there's a 50,000 deficit, because if you look at what the book value is. It says book value of 330 and you sold it for 280.
Yeah, 280 sold for 30 is minus 50,000.
So your tax is 14,500. So you get your tax, your scrapping allowance. So you get back. So you basically, it comes to 294,500.
Yeah. So minus 50,000 times the tax rate. The tax rate here was 29%.
That's 14,500.
14,500, which you'd have to add to the 280,000. I see. I haven't done that.
Which gives you.
I just didn't include the 14,500.
And then it gives you 249,500 is the total that you minus is the total for the proceeds of the sale of the old asset.
That's right.
Okay. And then you've got changes in net operating cash flow. There are none. It doesn't mention anything about that type of thing in the question.
Yes.
Your total initial investment is 155,500.
Yes.
Cool. Okay. The next part of it is your operating or the incremental cash flows. So what you have to do is you have to work out the cash flows for the old machine and the new machine.
Definitely. Incremental is always new minus old.
Yeah. So let's start with the old. So it tells you you've got 200,000 is the earnings before tax. Okay. So you don't have to do revenue because the other one you actually have to work out the revenue and everything. Your depreciation is 110,000 straight line. Your EBRT is 90. There's no interest because it doesn't mention anything about financing. So your tax is 26,100.
Yes, for the old. Good.
I've given you a profit of 63,900.
Yeah.
Add back your 110 gives you 173,900.
Yes, good. So yeah, your cash flows for the old are spot on. That's correct for all 3 years.
Okay. Yeah. Okay. So then for the new, would be your new one would be so. I mean, there isn't really any difference. So I mean, I don't know why. I mean, it's pretty much the same. Okay. So your revenue is 400,000.
Yes.
Each year. Your fixed cost is 100, and your variable is 40.
Yes.
So your earnings before.
EBRT.
Yeah, your earnings before depreciation is 260.
Yes.
Minus your 150 on depreciation leaves you with 110. Same thing, no interest.
Yes.
Your tax is 31,900.
Good.
Profit 78,100. Your depreciation 150, and your cash flow is 228,100.
Good.
So your incremental cash flow is 54,200.
Yeah. So incremental is obviously this, which is the new, which is that, which is the 228,100 minus this, which is the old, and then we get the Y1 to Y3 cash flows. So incremental every year, 54,200. Good.
Cool, 100%. I'm happy with that. Okay, so then for 1.3, you had to work out the net present value on whether you would go ahead with the project or not. So you take the initial investment as cash flow 0, which is the 155,500. Wait. I might have made a mistake here. I just want to check something quickly. 155 minus, that's cash flow 1. 54,200, 23, 12% is I. Net present value. No, I was a little bit out.
What did you get?
So I've got it comes to a minus. There's a.
It shouldn't. Okay, question. What do you do when you work out NPV? What cash flows do you need?
Well, you need the outflow, which is cash flow 0.
INV.
Yeah, you need your initial investment and then your cash flows.
OCFs.
Yeah.
What else?
And then you need your interest.
No. What about the TCF? Terminal cash flows at the end of the period.
Okay.
Right, so don't forget about that one. You need to do a small little working for TCF.
But it doesn't mention anything. It doesn't mention anything about TCF here.
Well, have a look at the question. What asset will you have at the end of the project?
Okay, but it doesn't mention anything about this. How much you're going to sell the asset for? So what do you assume there?
Resale value.
Yeah, but that's the current asset.
Current resale value.
You've already
existing.
Yes, but you've already taken that into that. That's already in your initial investment?
Yes. Okay, hold on. Am I looking at the right one?
Yeah.
What did I have here? Oh, 450. Yes, this is what I did. Okay, so yeah, existing was the resale, which was the current agreed. That's the old asset that you use in the initial investment, 100%.
Yeah.
Okay, then when you look at the new oven, right, the new oven is going to be the book value at the end of 3 years.
The 30%. 30% of purchase price.
There we go. That's the right one that we're supposed to be looking at.
Okay, so you have to calculate the terminal cash flow before you can calculate the NPV.
Of course you do, because TCF is part of the timeline.
Okay, so that's what I did wrong there.
Okay, it's not a difficult calculation because the old would actually be 0 because this asset, the book value of the existing oven would be worth nothing.
Yeah, so I mean it's really that the 30% of 450, so it's 150. No. 450 times 30% equals. So it's 135 minus the tax rate.
Minus the tax, yes. Agreed.
Minus tax. That's 29%. So that leaves you, so it's 135 minus 29% equals. So 95. So in the third year, your cash flow would actually be, it wouldn't be 54, it would be 54 plus 95,850.
Yes.
Okay, cool. Let me work that out quickly.
Okay, so see, the diagram's important. That's why when you do an NPV calculation, always draw a picture. Like I've drawn a little sketch here. T0, T3, T1, 2, 3.
Yeah, you see, I did what I did there. I actually did the diagram. I did that whole thing like that, but I skipped over the real sale value after 3 years.
Oh,
okay. So I just made the assumption that there was that the machine, because it had been used for 3 years and the depreciation was 150, I just overlooked. It was just an error of I just didn't read that line properly.
Okay, yeah. Just be careful because they did talk about the proceeds from the sale.
Yeah. So I just didn't read that. I didn't read that. That's why I didn't. And actually, I looked at it and I just didn't click on it. To be honest, let me just work this out quickly. So it's 155,500 minus that's extra 100. 2. Is cash flow 12% is I, the present value. So that gives you a positive 42,903.39.
Positive 42, no. Positive 28.
155,500 minus 54.
Oh, hold on a sec. I think you might be right. I think I didn't put in the 155. Yeah, 1550. Sorry, this should have been 155.
Yeah.
15550. So I think I need to redo my working. 15550. Okay, let me redo my working just to double check that answer. Where's my calculator? Okay, got it. Alright, so let's just double check it and see. 12% cost of capital minus 155500.
12 is I. Net present value. Definitely 42,903.
Okay, let's check. Plus 95850. Escape. PV. Okay, agreed. Yeah, sorry, you're right.
Cool.
Okay, 42903.39149.
Yeah.
So the decision would be to replace. Agreed?
Yeah. Yeah, we to replace because the net NPV is greater than 0.
100%.
Yeah.
Okay, this was a very good question, hey?
Yeah. Question two is a whack one.
Okay.
Yeah, so like I'm picking up quite nicely on these little things that I'm missing out. So I think I would have got, I probably would have got.
You would have got an 80 out of that question. You would have missed that last bit.
I probably would have got 25. I mean, I think that question was out of 35, I think.
No, it was out of 20, wasn't it?
Out of 20 marks, yeah. So I would have got about 19. I would have got like 19 out of 20 for that.
No, I think probably 17 or 18 because you missed the TCF. Yeah. The TCF would have had probably 2 marks, maybe 3. So maybe 18 out of 20.
That was only 3 marks for that last bit.
18 out of 20.
So, yeah. Okay. Then what you do is, for the next one,
this was a good question as well.
Yeah, it's just a WACC. So I mean, there's only really you don't go over the 120,000. So you only need to work out one range of WACC, because all the projects basically, even if you add up all the projects, you don't go over the net income even of it. So yeah, which is basically what your retained earnings would be, because it mentions the residual policy. So I basically just calculated the WACC is the equities at 60% times 16 gives you 9.6. Debt is at 40% times by 8.52, which is the cost. It doesn't mention anything about tax. No, it does.
It does. Tax rate is 29%.
Did I not do that? Sorry, I just want to check something quickly. Oh, no, I did already. I did. The interest rate on debt. So I've already, no, the 8.52 is it's already been adjusted for tax.
Okay, fine.
So I've already adjusted it because it's 12%. So I've already adjusted it for tax. That gives
What's
you 3
your
point.
WACC?
Sorry?
What's your
My WACC is 1301.
1301. Okay, I get 13.008.
So yeah, I rounded up, but I mean it's not really going to make a difference. I mean I rounded up to 01.
Okay, you wouldn't round up to 01. You would round off to 0 then.
No, to 01 because you've got 008.
So it would have been 13.01.
Yeah, 13.01. Yeah,
Okay, then that's fine. I thought you just said 13.1.
No, 13.1301.
01 is fine.
Yeah, 1301.
Okay.
Okay, and then you would accept. I actually mentioned that I rounded.
Good.
You accept projects 1 and 2, and you don't accept 3 because the IRR is less than the WACC.
No, the IRR for the last one is also higher. 13.4 is greater than 13.1.
Oh, okay. Okay. Yes, man. I don't know why I didn't read that.
Yeah, even if you use 13.1, it's still bigger. So all of these will be accepted.
Okay.
Something else would be: is this mutually exclusive or okay? They didn't mention it.
No, they didn't. Well, I mean, it would be because you've got enough debt. Because it says you've got enough debt, so you've got enough debt to basically cover it.
Yeah, but mutually exclusive and independent talks about the projects in terms of their nature.
Yeah. But I think what they're saying is they're saying that if it's under the 120,000, so if it doesn't go above the 120,000, you're fine.
Well, that's just the expected net income. Yeah. Well, that would be 120 in terms of available equity.
Yeah.
So I mean, we'll look at just now because that's the residual theory. Yeah,
so I mean, if the 3 projects don't go over the expected income, you can fund it all without debt.
Definitely.
So if you've got 60%.
You would accept all of them. But remember, you would still need debt.
Yeah.
Because the capital structure is 40% debt.
Yeah, but that's why I'm saying, like, if the 3 projects, if you could fund all 3 projects with the net income and you own all with the equity.
Sure.
And you have to use 40% debt, you can definitely.
Yeah, of course.
If you look at the weighted average cost of cap, if you look at the breakpoints, so that's why I assumed that it would be that they were independent.
Yeah, that's good. Yeah, well, independent doesn't mean that you can accept all the projects. Independent talks about the nature of the project. So basically, the projects aren't related. That's the thing. It's actually got nothing to do with whether there's enough capital or not.
They're not related is because there's no capital rationing. If there's capital rationing, then that's why you have mutually exclusive projects. It's because you don't have enough capital.
That's not accurate. The theory there is not accurate. Okay, so maybe let's revise that concept. Okay, mutually exclusive.
Yeah.
Means I can only accept one project because accepting A will eliminate B.
Yeah, and generally that's because you've only got budget for A or B.
No, it's got nothing to do with budget. You could even have, 10 times the budget. If you accept A, B's gone.
Okay.
It's got nothing to do with budget. It's look at the nature of the project.
Yeah, okay.
And then independent are 2 unrelated projects. Okay, unrelated meaning you can accept both of them. The cash flows of the one isn't affected by the cash flows of another.
Okay.
Okay, so it's kind of like looking at I think the one that they use in the textbook is like a repair, where you're either looking at restoring or fixing a machine. Okay, so you've got a machine. Right, so the option is, do you buy a new machine or do you repair the old machine? But you only need one machine.
Yeah, I understand it. That's fine.
Okay, so if I buy new, repair's gone.
Yeah, 100%.
If I repair, new's gone. That's mutually exclusive.
Yeah, 100%. I understand it. Thank you.
Independent is, do I produce product A or product B, and they're separate products.
Yeah.
So I mean, I can sell both products. That's not going to make a difference.
Yeah.
Okay. So just be careful. It's got nothing to do with the amount of finance.
Yeah. Okay. But if they don't mention that, then capital rationing must have some sort of impact on it.
Because no, not in this case. Capital. Yeah. See, that's the thing. The capital rationing or the capital available or the budget, it has nothing to do with the mutually exclusivity of a project or the independency of a project.
But they don't mention mutual exclusive or independent projects in this. So they say... So,
I'm just mentioning that if they do discuss mutually exclusive or independent, then you would have to discuss it.
Yeah, 100%. But my reasoning on why I didn't think that it was either of those is because because you had enough budget to do all of the projects and it didn't mention...
Yeah, and just be careful with that. That theory is incorrect. Yeah, it's the independent or mutually exclusive doesn't depend on whether there's enough budget or not.
Yeah, understand.
Okay. Right, so you got 6 out of 6 for this one. What does 2.2 ask for? Residual theory of dividends. They want the dividend.
So I mean, you just got to work out. 60% of 80,000 because the capital requirement is 80,000. No. So I'll work this out. I actually got 5 out of 6 for the last one because I said no to the last project. So I'd have to this would obviously be incorrect because I didn't work that out properly. So it would be 60 of 120.
Your dividends. Okay. How are you calculating your dividends? What are you using to get it?
Well, because if it's the residual theory, the residual dividend theory, whatever's left over after you funded your projects is what gets paid out.
Correct.
So if we're looking at that, we're going to look at 3 projects, okay, and they're going to cost 120,000. So we need to take 120,000, which is our total earnings, and we need to times that by 60% to get what is residual.
Okay, now be careful because this is looking at the dividends. How much should they pay if the residual theory of dividends is applied? So we're obviously looking at how many different projects.
We're looking at 3 different projects, but if you let me explain what I've done, I'll tell you how I get there. Yeah. So I just need to recalculate the answers because I only accepted 2 projects. 60% equals 2,000. Okay, so net income minus 72,000 equals. So I came to a thing of 48,000 is what the total dividends that would be paid.
When I accept how many projects?
If you accept all 3 projects.
If you accept all 3, yes. Okay, so what you should do, because this was out of like 6 marks, I doubt that one calculation is going to get 6 marks. Okay, and that's why I did 3 calculations. Okay, so what I said here was, in terms of new finance, if I accept 1 project, I need 40,000. Do we have retained earnings for 40,000? Yes. How much of the 120, okay, are we going to be using? Only 24,000. So the dividends, if I accept 1 project, would be 96. That would be the payout for 1 project.
Okay.
All right. If I accept 2 projects, so if I look at accepting B as well as A, new financing required will be 80,000. Retained earnings stays the same. Now I'm going to need 48,000 in terms of equity in order to finance that project. And therefore 72,000 will be left over to be paid out.
I understand the theory behind that. I'll do that in future.
Okay. And then the last one is what you had right. So you would have gotten this right. So my thinking here was it was probably 2 marks, 2 marks, 2 marks for each of these calculations.
It it also says how much would be paying in dividends if it follows. Oh, no, don't worry. Because I think there was another one.
I mean, if I had to allocate my mark allocation to my working, I would have given 2 for that, 2 for that, 2 for that.
No, I understand that. Yeah, perfect.
Okay.
Yeah, I understand the workings about it. I'll remember that for the exam.
Okay.
If that comes up. Okay, the payout ratio is quite easy. We've had it. The payout ratio is pretty much. Okay, so this one also. Would you do 3 payout ratios?
Yes, you would, because this is for 3 marks.
Okay. Yeah, so I only did 1, so I'll make sure that I do.
Okay, what did you get for the 1?
So the one that I did was I only accepted 2 projects when I did the initial calculation, so I got 60%.
For which one? How many? For B?
It was 72,000 divided by 120.
Yeah, that's perfect.
Yeah,
so your working is correct. Just do 2 more calculations.
Yeah. Perfect.
Okay. Yeah, because this is looking at the amount that you have available.
Yeah, 100%.
Residual theory of dividends.
Yeah, I understand that. I'm quite good with the residual theory. The only thing I didn't do is I didn't think about doing all 3 of them.
Okay.
For that. I would have got probably 3 marks. 3 marks here. And 3 marks and 1 mark there. So that was out of 12, 15. 10 out of 15 for that.
That's really good.
Yeah, so I'm already sitting on 28 out of 35.
Good.
Okay, then the next one was maximize EPS.
Yeah, this was a nice question.
Yeah, okay, so what I did was, it's obviously, I put the formula EPS equals preference divided by a profit minus preference over ordinary.
Yes.
So the first thing you had to do is you had to calculate your total equity and then your total debt at 40% and your total debt at 50%.
Yes.
So your total equity comes to 3.5 million.
Total equity 3.5 years.
Yeah, 350,000, sorry. I put an extra 0 on it. And then your total debt at 40% is 140 and 175.
Yes.
Okay, so then you got to do the capital structure. So you do your whole revenue breakdown on all 3 of them.
Good.
On both options.
Revenue?
Okay, so 530 is the revenue.
Yeah, for all the years, fine.
It gives you that. Okay, so you got 530.
Sure.
Your fixed costs are 251 because it's the same for both.
Yeah.
And then 105 for the variable.
105, no. Variable is 159.
Sorry, hold on.
Variable cost is 30% of the sales.
You know what I did? I used 350 at first. I swapped it around. I did 350 instead of. Okay, let me just fix this. Variable is.
Yeah, variable cost was given in the question as 30% of the.
Yeah, but just when I originally made a mistake, I wrote down 350 instead of 530 when I originally calculated, and then I didn't. Yes, it's 159.
Yeah, you get 159 is correct.
Yeah, 159. Okay, so I would have actually done quite badly at this. I would have been stuck off pretty much after this. The EBRT would be. Can you just? I've got it. Yeah. So it's 120.
Yeah, 120 is correct for the EBRT. Nice.
Yeah. Okay.
Yeah, you should still have the right interest though. Your interest should still have been correct.
No, I had 175 for the EBRT.
For the interest?
No. The interest is 25.
Yeah, so 25, 200, and 35,000.
Yeah, and 35,000.
Yeah, so those amounts are still correct. Yes.
Yeah. Okay. Minus 25, 200 equals.
Yeah. So even if you made a mistake with the variable costs, some of the other things should still be right. You wouldn't have lost that mark, the interest.
20 minus 35. So it's 85,000. Okay, then the tax would be wrong, so that's times by. The tax rate is 29%,
Tax here was
50.
30%.
But no, is it 30%? Why have I got it at 29%?
Be careful. Subject to 30% tax, here's it.
Yeah. Just want to actually just see something quickly. No, I actually did. No, I didn't do 30%. Yes, what a job. Well, it would have been wrong anyway because my thing would have been. Okay, so that's 25,500. 59,500. And 94. Divided by 6,000 it's 11.06 and 59,500 11.90. Okay, so I've got 94,000 for project A is the EBT and 85,000. Then you've got 28,440 is tax for project A, 25,500 for project B. Comes to 66,360 and 59,500.
100%.
Yeah, then you got 63 divided by your 6,000 shares.
Yeah, because you had to work out the number of shares, correct?
Which is 10,000.
Yes.
And then you get to 11.06, and then it's 5 divided by, it's the 59,500 divided by 5,000 gives you 11.9.
Yes, that's correct. And remember, we would expect the EPS to go up when we introduce more debt. That meets the theory.
Yeah, 100%.
Nice. So, conclusion?
The conclusion is you would go with debt structure B.
Definitely.
Yeah.
Good.
Okay, then I looked at October 13.
Okay, let's just save that. Was that the end, eh? That was question 3. Was that the last one?
Yeah.
Oh, there was only one part. Wow, 15 marks just for one question.
Yeah.
That's major. That's hectic. That's big. All right, so just be careful with, I mean, you used the wrong tax rate. You made a silly mistake with the variable cost. Other than that, you would have got 15 out of 15.
Yeah, 100%.
Okay, be careful with those things.
Well, be careful with those things.
Yeah, don't rush too much as well. Remember, you've got 2 hours of the exam. Use the 2 hours if you need to.
Yeah, I wasn't trying to rush. You know what I did is I went and I changed. I picked up that the 350 was wrong, but then I didn't go and change the variable cost.
Ooh, okay.
Because I thought it was just a stupid thing because the variable cost was based on a percentage.
Sure.
It wasn't a given amount.
Yeah,
so
it wasn't given, yes.
Yeah. So that was the only thing I did. Okay, so what I did here is I actually did the long questions first.
Okay, so let me let's reset again.
This is what I need to use here. And just remember the formulas so that I've got the formulas there so that I don't have to go check. Well, I won't be able to go check, but just so that I know the formulas and then just go through, just pick like random questions out of different exams and just see. And then just redo them a couple of times tomorrow before the exam.
My perspective is things are really looking good. You're going to crack the exam tomorrow.
Yeah, I think so as well. I'm quite happy compared to what I was like last week Monday or last week Wednesday.
Yeah, it's looking really good. So just keep it up. So I think maybe if you want to end now, that's fine. Then we can start again at 5:30. Gives you some time to go through more questions.
Yeah, cool. 100%.